Morning, everyone. Good to see you all again today. So we've heard a lot about risks and uncertainties coming up, or expected. And if you were listening to Dan's presentation yesterday, you probably want to run for the hills at this point. But if you are considering staying invested and you're looking at your equities portfolio, I think you might be thinking about whether it's time to sort of, improve the quality of your portfolio in order to weather the storm. And today we've got Sunil Thakor here, who manages the SANS Global Leader Fund, which has a quality growth tilt. And he's going to talk to us a little bit about why those investments potentially can weather the storm a little bit better. My fun fact about Sunil today is that he has a keen interest in the weather and actually has a secret desire to be a meteorologist. And even though I'm told I'm dressed like someone from Star Trek today, I can't say I actually know what that is. But here's Sunil. The last thing I'll just leave you with, because you probably realized yesterday I like saying nice things about my presenters. I saw Sunil present at a conference earlier this year. And there were two people from Columbia University who presented back to back, and then in the break, I was chatting to someone and they said, I don't know, is there something in the water at Columbia University? So I think you're in for a treat here, and please enjoy the presentation. Thanks.
Well, good morning. I'm going to try and give a little bit of a cheery presentation, but first, thanks for having me. I know a lot of you traveled a very long way to be here, and it's very much appreciated. Our firm has always enjoyed our partnership with Momentum and, by extension, with all of you. So, to jump in, my goal this morning is really just to make a very simple, I think somewhat intuitive, but I would assert very powerful point about the kinds of businesses that will prove to be resilient in different types of economic environments. Particularly, we'll use the environment of high, persistently high, sticky inflation and walk through a few examples of how it will affect different kinds of businesses in different ways. The other thing, a little treat, you got the growth guy up here, and I'm not, aside from right now, going to mention AI. And I'm not going to get into a lot of tech companies, not because we don't think it's important. We spend a ton of time thinking about AI. We've got investments all over the semi-value chain. But I think there's other really interesting stuff going on in other parts of the investment universe that are great examples of resiliency through a challenging economic environment and higher inflation. Now, from a macro perspective, and I think Peter covered it very well, so I don't need to repeat, but a lot of ink has been spilled trying to think through what are the implications across the investment universe, across asset classes, of persistently high inflation. And in our world, that means what is the impact on equity returns, equity profitability, business profitability, and ultimately real returns that we can generate from the asset class. From a macro perspective, I think it's unambiguously negative. And if you just oversimplify, you've got labor, you've got capital. Those are your two raw inputs of production. The capital buys labor and raw materials. So if those two things go up in price, the cost of that has to be borne somewhere. So at a systemic level, what's going on from an inflationary perspective is not good. But when you get down to a micro level, inflation's impacts are not distributed evenly. It's a massive, massive, massive gulf between different types of businesses and different industries with different market structures. A simple framework that we like to think about, and it goes right to the core of our investment criteria, and just as a quick diversion, our basic approach to investing is we want to take a private buyer's mentality to owning public equity. So really a business owner's approach, and our belief is that earnings growth ultimately is the driver of long-run return. And core to that philosophy is we only want to own leaders. Companies are the best at what they do. A disproportionate amount of the reward in any industry will accrue to the leader by definition. And the way you sustain leadership is through some sort of a competitive moat around the franchise. We would assert that if you have those two things, you also have resilience against headwinds like inflation. So I love the Ayrton Senna quote, which is, you cannot overtake 15 cars in sunny weather, but you can when it's raining. And I think that's what's going on across our equity portfolio across a number of businesses that during a challenging environment, that lowering tide, those headwinds affect everybody. You can't avoid and escape entirely the macro environment in which you operate, but competitive gaps can expand. You can sort of think of a recession or an inflationary environment or some sort of exogenous headwind as a bit of a brush fire that helps clear out the weaker players, and it creates a larger relative gap between the best and all the rest. And you might not see it flow through to business profitability in that moment, returns in that moment, but the seeds are being sown for sustainable growth coming out the back end of the environment. And that's what we would assert is going on right now. So this is not an exhaustive list, but a couple of examples that I want to run through briefly to just show how quality growth in businesses in a challenging environment, when they are price setters, or if they're the kind of business that can drive efficiency, often through automation, or leverage their scale or innovation in some way, can really push the inflationary impacts somewhere else. And if you think about competitive advantage and some of these characteristics, what competitive advantage really means in this type of environment is, what is your ability as a business to pass the buck to some other part of that value chain? Because, like we led off with, the cost has to be absorbed somewhere. So how much of that do you have to absorb through either lower sales or lower margins? And how much of that can you just say tough? Somebody else has to deal with it. So if we start with the price setters, there are several niche areas, particularly in the physical world, we've found, where there are near monopoly businesses because that's the natural market structure that works best for all participants. Favorite example of that is the aerospace industry. If you look across the aerospace supply chain, there are an uncommonly high number of monopoly businesses. And the reason for that is twofold. Aerospace is incredibly complex and has high safety standards, and unit volumes are very low. So a couple thousand commercial jets a year versus 100 million automobiles. So it doesn't make sense to have 5 suppliers of seat belts, 5 suppliers of lavatory door latches, 5 suppliers of galley coffee makers. Every one of those things I just mentioned are absolute monopolies in commercial aerospace. So a business like TransDigm is a company that acquires small parts suppliers with high aftermarket exposure, uses the free cash flow from those businesses to go buy more businesses that look like what they already own. 80% of their revenue comes from business lines where they are an absolute monopolist. And many times, how many times have you been stuck on the ground where it's a 50-cent part, a $5 part, something basic in the plane that's not working? That $100 million asset is grounded. So in that type of environment, a company like TransDigm has an enormous amount of pricing power, even when there are pressures in other parts of the system. Airlines paying more money for fuel, airlines paying more money for labor, but if they want that plane off the ground and they need a part from TransDigm, the price is whatever TransDigm says it is. And those sort of naturally opolistic type businesses, in our view, enable some of the strongest competitive moats, because regardless of the environment, the power balance sticks with the company that has the opoly, if you will. Another kind of business that does very well in a challenging environment are the automators. So a business that is selling something that solves part of the problem businesses are facing. So industrial automation, I think, is one of the most durable secular trends in the global economy. And basically what's happening are two things. Labor costs are going up. There's less labor out there with demographics in a number of geographies. And the products we're trying to make are becoming increasingly complex and high precision. So Keyence is a Japanese company that ostensibly they sell hardware, but what they're really selling are point solutions for factory automation that can reduce costs, increase efficiency, lower waste. So to use a very simplistic example, you have a bottling plant, a Coca-Cola bottling plant. The bottles are coming down the assembly line. Instead of spot checking the bottles at the end to see if the labels are on right, you can scan every individual bottle as it comes by, stop the assembly line immediately when there's an issue, and then you reduce your waste, and you don't have to have somebody there hand checking it. Now, expand that to all the kinds of manufactured products out there in the world, and you see the addressable market for these types of tools. Keyence is a leader in vision sensors. So sensors that in one way, shape, or form can see what's going on, inspect something, and then provide feedback to the operator. And that often removes labor costs and removes raw material costs. So they sell a solution. The company generates software-type margins, at 50% plus operating margins, gobs and gobs and gobs of free cash flow, and you'll see growth actually tick up during some challenging environments because the pie may shrink, but the focus on efficiency within the manufacturing pie goes up. And then the last example are the scalers or companies that are highly innovative that are selling a product that is benefiting from some sort of secular trend or is making some other product better, and that allows them to sustain margins because the underlying product has some value to the consumer that's very hard to get elsewhere. So a company we love to talk about is Sika, and if you're not familiar with it, it is a construction materials business based in Switzerland. What they do is make additives and adhesives that make other products like concrete more rigid and less carbon intensive. So the ethos of the business is to reduce the carbon footprint for their customers. And if you look at global CO2 emissions, construction and the construction supply chain is one of the largest contributors of CO2 globally, right there with agriculture and a little bit behind transportation. So it's a big area where there's an enormous amount of focus, and a lot of that carbon intensity, almost 10% of total global carbon emissions, are coming from the concrete value chain. So Sika is providing solutions. They're not in the commodity parts of the business. They're providing relatively small but important inputs to concrete manufacturing, insulations, adhesives. What I've got a picture of here is the world's first negative carbon footprint building because of the joint fillers, the waterproof membranes, the solar panels on the roof, the glass that's insulating. All of that has different kinds of Sika products. And so, again, you have cyclicality in construction. You have price sensitivity to the raw materials that a contractor is going to buy. But if you're a little supplier somewhere in the value chain that sells something that makes everything else downstream better, and there's a secular tailwind behind demand for those kinds of products, you can do very well and, again, push the cost of other raw material increases elsewhere. Each one of the examples I just went through over the last year has seen rising margins, not declining margins, rising free cash flow, not declining free cash flow, and that's despite the economic headwinds that are out there. And to tie it all together, there's a few common threads beyond what I just mentioned. First, notably, each one of those businesses operates in the physical world, not the digital world. And an observation that we have had is that as much innovation and value creation as there is in the digital world, and by reputation, Sands unapologetically invests in a lot of digitally disruptive businesses. It's an important part of all of our portfolios. But competitive moats can often be even stronger in the physical or the analog world. And part of that is because so many things in our physical environment are completely bespoke. That leads to a number of niche industries where you have a small provider of something that dominates a particular widget, but the economics of that industry don't support multiple players. And then because of the capital intensity of the physical world, it's often uneconomic or challenging to walk away from investments you've already made, which provides a larger time gap to sort of disrupt an incumbent. And this is a double-edged sword as we think about rewiring the physical economy to have a more a greener climate. But as we think about what that means for competitive advantage of existing entrenched players, it can be very tough to disrupt and unseat companies that are dominant players in some sort of necessary physical part of the world. Another common thread of each of these companies, the product or service they sell is a very small percentage of the operating cost of the customer to which they sell. So if steel is 50% of your costs or labor is 50% of your cost, the coffee maker in the lavatory or a coffee maker in the galley being sold for $5,000 instead of $3,000 is not your biggest problem. And that's, I think, a really interesting dynamic as we think about constructing a portfolio that can thrive, at least survive and thrive in a challenging environment. And if I step back and generalize this to longer-term equity investing generally, and not just specifically in an inflationary environment, I'd offer a couple of thoughts. One, if you look at equities over any long period of time, nearly 100% of total equity return is driven by the combination of earnings growth and capital return. It's generally considered to be about a 50-50 split if you look at long time periods. I think the number's actually probably a little bit higher on the capital return because a lot of capital return is coming from stock buyback, so you might not see cash flow from it, but it's below the line and reducing the share base. And it makes sense because the way you create equity value is by doing something that earns well in excess of your cost of capital, which then by definition means the whole point of starting a successful business is to create some activity, to engage in some activity where you generate meaningful excess capital. Now, that doesn't mean you have to be doing it at the moment. That's how we think about investing in disruptively innovative companies. But you should have some idea of what kind of excess capital generation is coming down the road. So it makes sense that the byproduct of all this excess capital generation that is sustained, the ability to do that is sustained by competitive advantage, is what drives the bulk of equity return. But another observation is that a very small percentage of the total opportunity set creates the vast majority of that value. We would assert that the reason is that competitive advantage, as simple of a concept as it is very hard to get and keep in the real world. Some of the characteristics I just laid out are frameworks for thinking about how do you find businesses that can sustain a durable competitive moat and therefore the ability to generate excess capital over the truly long term, owning business for 10 years, 15 years, 20 years. But generally, competitive advantage is more fleeting for most businesses. And you put all of that together, and it leads us to want to put together portfolios that are often down these back alleys, off the beaten path, and put together an eclectic mix of businesses that are doing something really, really well that's very hard to copy. And that's a good recipe in a good environment or a bad environment. And, I go back to the quote that we opened up with. I think this is what's going on now in a lot of our portfolios. Still grinding out earnings growth, still generating lots of free cash, still returning over half of that free cash to shareholders. You're not necessarily seeing it in returns, but these characteristics we believe are durable, and what we are right now is in the sorting time period that's separating the best from all the rest. And then to the future, as our late founder would always say, you want to be there, not be getting there. And in our view, these are the kinds of businesses where you want to be, whatever the economic environment is, but particularly if it's more challenging over the coming years, and we'll be well rewarded for it over the long term.